It's occurred to me lately that most people get retirement completely backward. They spend 40 years working, say what they can, and then just hope it's enough. I see it all the time. No real structure, no clear plan, just optimism. But hope, as they say, isn't a strategy. I'm 94, and retirement as a system has been on my mind, how people plan for it, how they fund it, and where they often go wrong. The problem I see is this: most people approach retirement backward. So let me be direct. There are 5 assets you must have before you retire. Not nice to have, not maybe, but must have. If a secure, comfortable retirement built on confidence is your goal, these 5 asset categories need to be represented in your portfolio. And I'm not talking about hedge funds or complex derivatives that require constant monitoring. These are straightforward, time-tested assets that have worked for decades, generating income, protecting purchasing power, and providing stability across unpredictable markets. Let's start with the first and most important asset: a diversified portfolio of high-quality dividend growth stocks. For retirement income, the foundation isn't bonds or annuities, it's dividend-paying stocks, specifically dividend growth stocks from companies with long track records of increasing dividends. When you retire, you need income, real income you can count on because you're no longer receiving a paycheck. There are only 2 ways to fund retirement from investments: sell shares, gradually reducing your principal, or collect cash flow from the assets you own without selling. Relying on selling shares puts you on a countdown clock. Eventually, you draw down your portfolio far enough that market drops become dangerous. And if you live longer than planned, as many people do, you can outlive your capital. Dividends solve that problem differently. With the right companies, dividends can continue indefinitely. You hold the shares, and the business sends you cash quarter after quarter. And if those dividends rise over time, your retirement income rises with them. This is why quality matters. You're not looking for high yield at any cost. You're looking for stable businesses with durable earnings and a history of increasing payouts year after year. Think of companies with strong brands, strong balance sheets, and long dividend records, businesses that have increased dividends for decades, not years. Names like Coca-Cola, Johnson & Johnson, Procter & Gamble, and McDonald's are examples of the type of company I mean: boring, stable, consistent. That's what you want in retirement: reliability. Now, consider the math. Say you retire with $1,000 invested in dividend-paying stocks yielding 3%. That's $30,000 a year in income. On its own, that might not be enough, but the key isn't the starting income, it's the growth rate. If those dividends grow at 7% a year, the income changes dramatically over time. After 5 years, you're collecting around $42,000. After 10 years, roughly $59,000. And after 20 years, well over $100,000. That's the compounding effect most people ignore. While programs like Social Security often struggle to keep up with real inflation, dividend growth can outpace it because the underlying businesses increase earnings and raise payouts. And here's the overlooked benefit: you didn't have to sell a single share to generate that income. Your principal stays invested, it can continue growing, and it can be passed on to your family. The dividends are income generated by productive companies, not money you withdrew from yourself. I've relied on dividends for most of my adult life. Berkshire Hathaway doesn't pay a dividend, but I've owned many businesses that do. And what I've seen year after year is that dividend income, when it comes from strong, profitable companies, is among the most dependable income streams you can build. So asset number 1 is clear: build a diversified portfolio of quality dividend growth stocks before you retire. Not 2 or 3 names. Think in terms of 10, 15, even 20 companies across industries, selected for durability, not excitement, and plan to hold them for the long term. That becomes your retirement income engine. 2, a low-cost S&P 500 index fund that you don't touch. Now, the second asset category seems like it overlaps. People ask, if dividend stocks are the income engine, why do I also need an index fund? Because you need both roles covered: income today and growth over time. Dividend stocks provide cash flow you can live on, but your retirement still faces risks, inflation spikes, unexpected medical costs, market volatility, or simply living longer than expected. You need a separate pool designed to grow quietly in the background, an asset you can tap only if needed. That's what a low-cost S&P 500 index fund does. It gives you broad expo to 500 of America's largest businesses. You're not making individual stock bets. You're owning the productive core of the U.S. economy over long periods, 20 or 30 years. It has historically provided. Imagine retiring with $700,000 in dividend growth stocks and another $300,000 in an S&P 500 index fund. It's a comforting thought, isn't it? The dividend stocks become your ongoing income, and the index fund quietly grows over the years, potentially multiplying while your dividend holdings continue to pay you. It's a portfolio structure designed for real life, with income to live on and growth to protect your future. Thinking about it, I see how a dividend portfolio can be like a checking account, providing the funds for day-to-day life, while an index fund acts as a savings account, untouched unless absolutely necessary. That $300,000 in an S&P 500 index fund could potentially grow into something far larger over 20 years, perhaps even millions, while your dividend holdings are still providing income. The goal is a portfolio designed for real life, income to live on, growth to protect your future, and a buffer for emergencies, all in a structure that won't collapse if one component has a bad year. The second asset I think about is a low-cost S&P 500 index fund held long-term and only touched in true emergencies. Then comes the third, income-producing real estate. I'm talking about rental properties, residential or commercial, that generate monthly income. Not your primary home, you understand. Your home is a lifestyle choice and an expense, not an investment portfolio asset. It might rise in value, but it doesn't pay you. It costs you taxes, insurance, repairs, and maintenance. And what truly matters for retirement is cash flow real estate, rental property that produces monthly income. Rental income tends to be stable and often rises with inflation. People always need places to live and operate. And as the cost of living rises, so do rents. Real estate can protect your purchasing power as your retirement expenses increase. It also adds diversification, not perfectly tied to the stock market. When stocks fall, rental properties often continue generating income. Tenants still pay rent, and that stability matters when you're no longer earning wages. Of course, not every property is a good deal, and being a landlord isn't effortless. There are headaches, but there's a reason real estate has been a wealth-building asset for centuries. It can produce income while preserving value. If direct ownership isn't appealing, there are REITs, real estate investment trusts. These businesses own and manage income-producing properties and pay most of their profits to shareholders, offering real estate expo without the hassles of tenants and repairs. Either way, real estate expo is valuable in retirement. It provides cash flow that tends to rise with inflation and offers diversification. Next, we come to inflation-protected government securities, TIPS or I bonds. This fourth asset is specifically designed to handle one of the most underestimated threats to retirees, inflation. Traditional bonds are often presented as safe, but in an inflationary period, they can be quietly destructive as fixed payments lose purchasing power as prices rise. TIPS, or Treasury Inflation-Protected Securities, work differently. Their principal adjusts with inflation. If inflation rises 3%, the principal value rises about 3%, and interest is paid on that adjusted amount. The goal is simple: protect purchasing power. Inflation can slowly ruin fixed income retirement plans. If you retire with $50,000 a year and inflation runs 4% annually for a decade, you lose a major portion of what that income can buy. Your $50,000 ends up functioning like roughly $33,000 in real terms, turning a manageable retirement into a stressful one. TIPS and I bonds provide defensive stability. They're not your main growth engine, but they protect part of your portfolio from inflation surprises. A practical allocation might be 10 to 20%, depending on the person. Not the majority, because stocks and real estate generally outpace inflation long term, but enough to provide insurance against worst case inflation scenarios. Think of it like this: stocks and real estate are offense, tips are defense. Finally, there's the fifth asset, a paid off home or very low housing costs. This surprises some people, especially since I mentioned earlier that your primary home isn't an investment. That's still true. But a paid off home is one of the smartest financial positions you can carry into retirement. Not because it grows, but because it dramatically reduces your largest expense. Housing is usually the biggest cost in retirement. If you're paying $2,000 a month in rent or mortgage, that's $24,000 a year. Over 20 years, it's close to $500,000. If you own your home outright, your housing cost falls to property taxes, insurance, and maintenance, maybe $6,000 to $8,000 a year instead of $24,000. That difference changes everything. It lowers the income you need to retire, reduces stress in down markets, and creates flexibility for medical expenses or emergencies. So if you're approaching retirement with a mortgage, paying it off should be a serious priority. Not the car, not the kitchen remodel, not the vacation, the mortgage. Sometimes math can suggest that investing beats paying off a low-interest loan, but I've learned that retirement isn't just a math equation. It's about something deeper. Security, peace of mind, knowing I have a place to live that can't be taken away because a monthly payment became too much. That feeling of security is almost priceless. If I were younger, my strategy would be simple: buy less house than I could actually afford. Choose a shorter mortgage if possible and pay it down aggressively. My aim would be to have it paid off by 60, or even earlier if I could manage it. That way I could spend those final years before retirement building other assets without a mortgage constantly draining my cash flow. If I were older and the mortgage was still large, well, I'd have to make some tough decisions. I'd consider paying it down with real urgency, maybe even working longer if necessary. Another option would be to plan to downsize and eliminate the payment altogether. What I wouldn't do is retire with a large mortgage and just hope it all works out. Retiring with a big mortgage payment is, in my view, one of the easiest ways to turn what should be a relaxing time into a period of financial freeze right from day one. That's why a paid-off home, or at least very low housing costs, is so essential. It makes the entire retirement plan far easier to sustain. Let's recap the 5 essential retirement assets. Think of them as a framework. First, dividend growth stocks, your primary income engine growing over time. Second, an S&P 500 index fund for long-term growth and backup capital. Third, income real estate, or REITs, for stable cash flow that often rises with inflation. Fourth, TIPS or I bonds for inflation protection and stability. And fifth, paid-off housing for lower expenses and higher flexibility. These 5 assets work together because they each protect you from a different risk: market crashes, inflation, longevity, and unexpected expenses. Once I understood that, the next question became obvious. How much should I have in each category, and how do I avoid the common mistakes people make? When you put these 5 assets together, something important happens. Your retirement stops depending so much on luck. If the market crashes, your real estate income and inflation-protected securities remain relatively stable. If there's high inflation, your dividend-paying companies and rental income can adjust upward over time. If you live longer than expected, your index fund continues compounding in the background. And if you have unexpected expenses, your paid-off home keeps your baseline costs low. That's not just wishful thinking, that's structure. It's a retirement built on confidence. It's confidence rooted in assets that have proven themselves over decades across wars, recessions, inflationary periods, and market booms. Now, knowing what to own is only half the equation. The other half is knowing what not to do, because I've seen people with decent savings still fail at retirement due to avoidable mistakes. Let me walk you through the most common ones. Mistake number one, putting too much money into bonds. Many people hear the word retirement and immediately think conservative, so they move heavily into bonds. That instinct is understandable, but I think it's also outdated. Bonds don't grow meaningfully over long periods, and they perform poorly when inflation rises. In inflationary environments, bonds quietly confiscate purchasing power. You receive interest, but that interest buys less and less every year. And here's the key issue most people overlook. Retirement can last 25 or 30 years, sometimes longer. A portfolio that doesn't grow is not conservative, it's fragile. You need assets that expand with the economy and protect you from inflation. Bonds can play a role, but they cannot be the backbone of a retirement strategy. Stocks and real estate are essential because they grow. Mistake number two, not owning enough income-producing assets. Some people retire with a large portfolio, sometimes $1 million or more, but it's invested entirely in growth stocks that don't pay dividends. Then retirement begins, and the question becomes unavoidable. How do I live? The answer is usually to sell shares. That means you're no longer living on what your assets produce. You're living on the assets themselves. Every withdrawal shrinks the portfolio, and one bad market year early in retirement can do permanent damage. This is why income-producing assets matter so much. Dividends, rental income, and interest arrive without you having to sell anything. They create a paycheck replacement. That's the difference between stability and stress. Retirement works best when money comes to you instead of you having to extract it manually from your portfolio. Mistake number three, retiring with a mortgage. This one cannot be overstated. Retiring with a mortgage payment is, in my view, one of the most damaging financial decisions a person can make. It dramatically raises the income you need every year and increases your expo to market risk. If you're carrying a mortgage into retirement, your portfolio has to work harder just to cover fixed housing costs. That forces you into riskier investment behavior at the exact stage of life when flexibility matters most. The solution is straightforward, even if it's not always easy. Pay off the house first, then retire. If that means working a few extra years, those years often buy decades of peace of mind. Retirement is much easier when housing costs are low and predictable. Mistake number four, lack of diversification. Some people put everything into stocks. Others go all in on real estate. A few park nearly everything in safe assets. All of those approaches share the same flaw: concentration. I've seen hundreds of retirements over a very long life, and the pattern is always the same. The good retirements belong to people who built the right assets. The bad ones belong to people who didn't. The difference, in almost every case, is preparation. By the time people reach retirement age, the outcome is usually already decided, not because of luck or intelligence, but because of preparation or the lack of it. I've seen this play out repeatedly over decades. Some people enter retirement calm, confident, and in control. Others enter anxious, constrained, and worried about every dollar. That difference is almost never about income alone. It's about whether they built the right assets early enough and stayed disciplined long enough. Retirement doesn't reward last-minute effort. It rewards long-term structure. That's why this framework includes 5 distinct asset types, each covering a different risk. Together, they're stronger than any single category alone. Different assets perform well under different conditions. Diversification isn't about maximizing returns. It's about survival and consistency. It ends that no single economic event can derail your entire retirement plan. One of the biggest mistakes I see is starting too late. This is the most unforgiving mistake of all. Now, you cannot build a durable retirement portfolio in 5 years. It takes time for dividends to grow, mortgages to be paid down, properties to appreciate, and index funds to compound. If you're in your 20s or 30s, time is your greatest advantage. Use it. If you're in your 40s, you need to act decisively and consistently. If you're in your 50s and haven't started, the margin for error is thin. You'll need focus, discipline, and urgency. And if you're in your 60s without these assets in place, the reality is harsh. You may need to work longer or significantly adjust expectations. There's no shortcut that replaces decades of compounding. That's not pessimism, that's arithmetic. The strategy changes depending on where you are in life. If you're in your 30s, focus on building your index fund and starting your dividend portfolio. Time is doing most of the work for you at this stage. Real estate can come later. If you're in your 40s, add income producing real estate. Accelerate dividend investing. Start paying down the mortgage aggressively. Begin building inflation protection if you're in your 50s. If you build these 5 assets consistently, retirement becomes manageable, not extravagant necessarily, but secure, calm, predictable, free from constant financial anxiety. So here's the challenge. After reading this, don't just nod along. Take action today. One action: buy your first dividend-paying stock, invest in a low-cost index fund, research rental properties or REITs, purchase inflation-protected securities, make an extra mortgage payment. One step today, another next week, another next month. That's how real portfolios are built, not in dramatic moves, but through steady, repeated action, eliminating uncertainty. Most people don't fail because they make terrible decisions. They fail because they delay good ones. They assume they'll figure it out later. They assume there will be time. They assume something external will save them. Time is the one thing retirement planning does not forgive. Compounding only works when you give it years, sometimes decades, to operate. Dividend income only becomes powerful after it's been growing for a long time. Real estate only becomes meaningful after mortgages are paid down and rents have had time to rise. Index funds only reveal their full strength when left untouched through multiple market cycles. You cannot replicate that process at the end. That's why action matters more than information. You don't need to build everything at once. You don't need to be perfect. You don't need a complex plan. You need to start one account, one asset, one decision made deliberately, then another, week after week, year after year. This is how people quietly succeed at retirement, while others wonder why it feels so hard. If you're younger, your advantage is time. Use it while it's available. If you're in mid-career, your advantage is earning power directed intentionally. If you're nearing retirement, your advantage is clarity. Act decisively. What you cannot afford is inaction. Retirement is not an event. It's a phase of life that arrives whether you are ready or not. And when it arrives, it doesn't care about intentions. It only reflects preparation. I've watched people assume Social Security would carry them. It didn't. I've watched people rely entirely on market growth. One downturn changed everything. I've seen how inflation can creep in unnoticed, slowly diminishing a person's quality of life year after year. But I've also witnessed something quite different. Individuals deliberately accumulating specific assets, ultimately achieving a retirement free from worry. Not lavish, not excessive, but safe, self-sufficient, and tranquil. These 5 assets, as I see them, offer something essential. They aren't about instant riches or easy solutions, but about respect, steadiness, and agency over your own life. So I want to propose something to you. Don't postpone acting until the perfect moment arrives. Don't demand complete assurance. Don't delay until everything feels perfectly safe. Choose one of these assets today and take action. Start the account, make the investment, reduce the debt, begin the journey, and then keep going. The future version of you, the one in retirement, isn't expecting flawlessness. They're simply hoping for consistent effort, applied early on, develop these assets, remain disciplined, and when retirement comes, face it with assurance instead of dread. That, to me, is the path. Follow it, and retirement can become one of the most secure and fulfilling stages of your life rather than one of the most anxiety-ridden.